Hi guys. This video is the second in our series looking at banks and monetary policy. In our first video, we looked at money, its functions, its history, its characteristics, and we overviewed central banks. And in these next two videos, we're going to look at how financial markets and commercial banks operate, which we're going to need if we're going to understand how the Bank of England effectively regulates the monetary system to achieve its macroeconomic objectives. In this video, we're going to look specifically at the nature of financial markets. We're going to introduce ourselves to the key terms, see how financial markets fit together, see why they're really important in the economy, and then zoom in on the bond market and play around with how we do bond calculations. Okay, let's start with the key terms. Two essential terms for understanding financial markets. We've got to know about assets and liabilities. An asset is something which an individual or an organisation owns. It has value. And it will normally cause money to come in, generate some kind of revenue stream, be that interest or future profits. A liability, on the other hand, is something which an individual or an organisation owes. It causes money to go out. It's something they're going to have to pay. An asset is something we own. A liability is something we owe. Take, for example, a loan from a bank to a firm. That loan, slightly confusingly, is an asset to the bank because the loan is going to be paid back plus interest. So they own that loan, they've got the right to it, and at some point the firm is going to have to pay back that loan plus interest. So it's going to generate money for the bank, it's therefore worth something. But for the firm, it's a liability because that loan represents something they're going to have to pay back. It's money that will have to go leave them and be paid to the bank. The simplest form of asset is money, which we've looked at. Money is an asset because it's got value, but it doesn't really generate revenue. There's a few other key terms we need to get our heads around, like liquidity, narrow money, and broad money. All of those we covered in our last chunk. So do go back and look if you're not sure about these key terms, because we'll need them as we dive in. A few more specific terms that we need to get our heads around. We'll sometimes hear the word equity, referring to assets traded in a financial market. So, for example, shares and bonds are sometimes known as equity. Equity, assets, they're interchangeable for our purposes. And when we hear liabilities, we're almost always thinking debt, but not always, as we'll see when we look at banks. Now, assets might be packaged into a portfolio. So the kind of institutions that we're going to be dealing with the financial markets, we're thinking banks, firms, but also things like hedge funds and pension funds. They'll often own a portfolio of different financial assets, and they'll do that in order to minimise the risk they're exposing themselves to and maximise their chance of good returns. And let's just pause here and think about what that portfolio might look like. So just take a moment to pause the video and think through these questions. What factors are firms likely to consider when constructing a portfolio? What do they want to achieve? When might investors prefer a risky investment to a safe one? Now, how are firms going to feel about assets which aren't so liquid? Well, hopefully you had a chance to have a think. And we should have considered a few factors with that first question. Obviously, firms want to maximise profit. That's one of our key factors. But they're also looking to think about risk and liquidity. That was the second question. When would investors prefer a risky investment to a safe one? Because we'd always prefer a certain return. But we'll take out a risky investment if the returns are really high. And lastly, how do we feel about less liquid assets? Well, we like liquidity, don't we? We like that flexibility. And guys, these three questions introduce us to some of the key principles behind financial markets. We're balancing profitability with risk and liquidity. If there's high risk or low liquidity, that generally leads to higher returns. We're going to see why this is in a bit more when we look at bonds, but basically, here's the principle. If there's really high risk for an asset, that means there's going to be less demand for it. If there's less demand, that has the effect of pushing rates up. We'll see why in a moment. Similarly, if an asset isn't very liquid, less demand, higher rates. It's a trade-off. The assets which generate the most profit are those which are the least liquid and the most risky. Two more key terms before we dive in to see how financial markets are structured. The first is just digging into this idea of equity a little more. We'll see these terms positive and negative equity. Positive equity refers to a situation when our equity or our assets are greater than our debts, our liabilities. We're overall, we've got a positive balance. Whereas negative equity, secondly, refers to the opposite. That would be where our liabilities are greater than our assets. Okay, lots of terms to get our heads around. A lot of financial markets, it's not that difficult, but there are quite a lot of technical terms. If you're unsure, go back through this video, have another look at what we've just discussed. The key principle to grasp here is this trade-off, profit versus risk and liquidity. Those are the three things firms are going to consider when they're constructing a portfolio. But let's dive into how financial markets are structured in a little bit more detail. There's actually three different areas that we need to be aware of. The first is the money market. I'll give you a brief overview of all of these incidentally, and then we'll move on to some detail in just a moment. Money markets are where loans happen. So it's money being loaned. Secondly, we've got capital markets, where firms can buy and sell capital. And we're really thinking stocks and shares here, which are sold initially on the primary market and then can be resold on the secondary market. And lastly, we've got the foreign exchange market, often known as Forex. And this is where currency is bought and sold. So any time I buy something from abroad, there has to be a transaction on the Forex market. There's two areas to this. The spot market is immediate transactions, and the forward or futures market is where future currency exchanges can be transferred. Let's see a little bit more detail in those. So the money market is straightforward. It's all about lending money and other liquid assets. So bonds, for instance, would go in this category. And that's crucial because it enables banks to remain liquid. Banks need to have sufficient liquid assets that if there is a sudden change in the amount of money they need to pay out, perhaps if lots of people withdraw money from their deposits, banks need to be able to meet those obligations. And when there are those fluctuations, banks often lend between each other in order to meet them. More on that when we look at banking in the next video. The money market is also crucial because it facilitates lending, it links savers and borrowers. And we love lending because it's through lending that we can get investment, we can effectively take future profits and turn them into investment now. So, and investment is really important for economic growth. Secondly, capital markets, which are crucial because they enable businesses to sell assets to raise funds to finance their growth. So big companies often sell parts of themselves. They sell the right to own them as shares. And that's what a share is. It's owning a tiny fraction of a company and therefore being entitled to its profits. When companies first sell shares, it'll be in the new issues or the primary market. And that's where that first sale of shares happens in what's called an initial public offering or an IPO. And that's normally offered, that's normally arranged using an investment bank who will facilitate the sale and advertise it. That's really important for firms to raise money. But when we talk about stocks and shares, we normally mean the secondary market, which is where shares that have already been sold for the first time can be resold between different investors. And when we talk about share prices of companies, those share prices are determined on the secondary market. And so we're thinking there about things like the London Stock Exchange, these big exchanges where stocks can be bought and sold. That might seem a little bit like gambling, but we're going to see in a moment that there's actually a really important reason why we need a secondary market for us to achieve the full benefits of having these capital markets. Okay, lastly, the Forex market, that enables currency to be bought and sold, which is obviously really important for international trade. The spot market is that immediate exchange of currency, right now, hence spot, it's kind of one-off. But firms often want to mitigate against the risks of currencies changing. See, currencies fluctuate up and down, and if I'm not sure about that, I might want to ensure that at some point in the future I can have access to the currency I need at least a decent rate. And that's what the forward or futures market is for, where effectively I buy the right to buy currency in the future at a certain predetermined rate. And that limits the risks of currency changes. It's effectively insurance. So I might buy the right to buy $100 million in pounds in a year's time. And that means that if the currency exchange rate changes adversely, I'm going to do all right. Okay, again, quite a lot of complexity here. I should reassure you guys, we need to know about the structure of the different financial markets. But most of what we need to know about financial markets comes in their application, which we're going to think about more when we look at financial market regulation. What is really crucial, however, is considering why financial markets are so important, which we've already spoken about a little bit. But let's dive in a bit more to see why financial markets are so important. And the big reason is that they enable firms to raise funds. Without financial market, we can't have any kind of access to credit or funds. So financial markets are crucial for consumption, so when consumers borrow to finance consumption, but also for investment, more importantly for investment. Financial markets enable banks to act as an intermediary linking savers who have money with borrowers who are looking to pay for the privilege of borrowing money. And that's really important for investment. We do have other functions which we'll talk about more when we look at regulation. One of those key roles is that financial markets are fundamental for there being insurance in a market, which is obviously really important for mitigating and managing risk. But the crucial role that we need to consider is this idea of financial markets acting to provide funds. So we need to consider how firms use financial markets to raise money. And there's 3 ways in which financial markets enable firms to raise money. The first is, as we've spoken about already, by shares. Firms can sell equity, can sell parts of themselves in order to raise funds to reinvest. So I might sell off 40% of my firm. I'm turning equity into funds, which I can then spend. Or just, if I'm an entrepreneur, I can enjoy. That could be my payout for setting up the company. Now, that initial public offering, as we've seen, happens on the primary market, but that couldn't really happen without the secondary market. If there were no secondary market to resell shares if the price goes up or down, there'd be much less demand for the primary market. If there's no secondary market, then when I buy shares in the primary market, when companies have their initial public offering, I wouldn't be able to resell my share. I'm stuck with it. So it wouldn't be very liquid. And as a result, we need the secondary market for the primary market to function. So yes, maybe it's true that the secondary market is kind of just gambling, but it is still important in providing this key role in the economy of enabling firms to raise funds. Secondly, firms can obviously raise funds using a bank loan. That's the money market where banks are lending money using deposits from savers. And a key term that we'll come across a little bit here is collateral. These loans might require collateral, which is an asset which the bank, which is kind of contingent on the loan being repaid. So if the loan isn't paid back, the bank has the right to seize that asset. So for example, in domestic mortgages, often the house itself is collateral. And if I don't pay my mortgage, the bank can take my house. Thirdly, and this leads us on to our final section of this topic, firms can raise money using a bond. And a bond is basically a loan. But it's a loan that can be offered to anybody. It doesn't have to be through a bank. So we'll talk about buying bonds. And buying bonds, if I buy a bond, I'm just lending to the person I bought it from effectively. Governments raise most of their funds using bonds. And it's not unheard of for corporations to do the same. Though when we talk about bonds, we'll mainly talk about government bonds. Buying a bond is like lending money. And similar to normal loans, bonds have a fixed term. They have to be paid back at a certain point. They pay interest. And they can be sold on a secondary market. If I've bought a bond, I can sell it to make some money. Now guys, we're going to zoom in on bonds, but before we do, just make sure you're happy with these 3 key ways in which financial markets can enable firms to raise funds. We need to be able to explain why financial markets are really important. And so the key link is explaining why they enable investment to happen. And if you're unsure about why investment is so important, why not go back to our notes on investment from when we were looking at aggregate demand. Before we move on, let's just check you can answer these questions. I won't go through the answers because you'll find them all in the video, but pause the video, read them through and make sure you can answer these questions. Okay, let's lastly move on to think about bonds. See, we need to be able to do a little bit of calculation with bonds. And that's really just to give us greater fluency in understanding how the financial market works. Bonds are a little bit tricky, but once we get our heads around it, they'll be straightforward. There's 3 bits of information about any bond. We need to know the par value, and that is the initial price the bond was sold for. For most bonds, that'll normally be £100. We need to know the maturity date, the date at which the bond will mature and can be redeemed. And that's the point at which the par value will be repaid. And finally, there's the interest rate or the coupon, which is the guaranteed annual interest earned by the bondholder. So for example, suppose I buy a bond for £100 initially. That might mature in 5 years, and that means in 5 years' time, I'll get my initial £100 back, plus every year I get paid interest. So bonds are a pretty good investment. If I've got £100 I want to invest, often bonds offer better returns than savings accounts. But bonds can be resold after being issued for a different price, but will always express the coupon as a percentage of the par value. And that's the only complicated thing that can trip us out with bonds. The par value is the size of the loan the bond represents. The market value is the price on the free market. And that market value will depend on a few things, but for our purposes, we're particularly going to think about risk. If the bond is perceived to be risky, the market price will fall. So for example, take government bonds. If investors don't think that the government is very likely to pay back the bond, they might be less likely to buy it, and so the market price will fall. And a great example of this was Greek government bonds. 10 years ago, the Greek government, still reeling from the financial crisis, was on the verge of financial collapse. And because of that, investors thought that they would be very, very unlikely to therefore be able to pay back the bonds that they had bought, that they had sold. And as a result, the market price of bonds fell. Now let's see what happens to bonds when the market price falls, because here's the really crucial mechanism. Let me give you an example. So here's a bond. It has a par value of £100. It has an 8% coupon and a maturity date of 2025. So let's say that's 5-year maturity. Now suppose I then buy this bond in the market and the price has dropped significantly. Let's think about what the effective interest rate will be. Well, to work that out, we need to work out how much this bond is paying every year. It's got a coupon of £8%. The par value is £100. That means this bond every year will pay out £8, because remember, that coupon is expressed as a percentage of the par value. So an 8% coupon of a £100 bond means an 8% guaranteed annual payment. Making the maths easier, 99% of the bonds we'll look at have a £100 par value, which means calculating that coupon as a figure in pounds is really easy. But just be careful if the bond has a par value that isn't £100. Then we'll just have to do a little bit of calculation to get that guaranteed annual payment, to get that coupon in pounds. So this bond pays out £8 every year. If I buy it for £50, well, that means that the effective interest rate is 16%, because I buy it for £50, but every year it's paying £8, and £8 is 16% of £50. Hopefully that makes sense. Have a look through if it wasn't totally clear the first time. But here's the key point. That effective interest rate is known as the bond yield, and it's the effective rate of return on the bond. And the key principle is that the bond yields are inversely related to bond prices. So when the bond price falls, the yield goes up. And that's because the coupon is fixed. So relative to the market price, if the market price falls, the coupon as a percentage of the market price goes up. Really, really crucial idea. And if we get our heads around it, we've understood bonds. And actually this applies to lots of areas of financial markets in a similar way. Prices and yields are often inversely related. Now we need to be able to do a little bit of calculation with this, and this is the last thing we need to look at before we just think quickly about the things that determine bond prices. Here's our formula. The bond yield is calculated by looking at the annual coupon in pounds divided by the market price times by 100. Now sometimes we'll have to do some rearrangement for this. I'm not going to go through how to do that in this video, because hopefully it's straightforward. So for example, suppose we've got another bond, it's got a par value of £100, 5% coupon, and it sells in the market for £80. Well, that means our annual coupon is £5, 5% of 100. So if we plug the information in, our bond yield is going to be £5 divided by the new market price of £80 times by 100. So when the market price drops to £80, the bond yield is 6.25%. That is the rate of return on this bond in the market. And incidentally, here's why that's important. Firms, if I'm a firm or a government looking to issue more bonds, I'm going to be constrained by that yield in the market. I won't be able to issue new bonds for a lower interest rate because nobody's going to buy them if they can get a higher yield in the market. And that's a particular problem for governments. So, for example, that Greek government bond example, government bond yields hit it's 37%. And that means if the Greek government wanted to borrow more, they had to offer a 37% interest rate. That's a bit of an aside. Let's do a bit of calculation. So here's what I'd like you to do. Here's a table which has lots of data on it about the interest paid. And remember, that's a percentage of the par value, the market price, and the yield. All of these bonds have a par value of £100. Pause the video and have a go at calculating the missing values. You'll need to do a bit of rearrangement, but when you get your head around it, it's not too tricky. And if you're not sure, do your best. And the best way to work it out is just to double check by having a look at what result you get and asking, is that plausible? If you got a market price of £5,000, you probably made a mistake somewhere. Okay, answers coming up. Last chance to pause the video if you want to go through them without seeing them. Here are the answers. Check through your work. And the best thing to do if you didn't get any of these right is to look at my figures and see if you can plug them into the formula to work out why they fit. And use that to figure out the best approach to deal with these. Okay, one more task to do based on bond questions. Here's another table. Now again, all of these bonds have a par value of £100. See if you can calculate the market price of them so that their yields are equal to the market interest rate. And you've got the market interest rate over on the right hand side. A little bit trickier to think through what that means, but I'll let you do it. I reckon you can rise to the challenge. Pause the video again, have a go at these last three. Okay, here's what I got. And again, the only tricky thing here was realizing that that market interest rate is just the yield, because we're trying to work out what the price would be for the yield to equal the market rate. So there's the answers I got. I won't go through how I got them, but if you're struggling, feel very free to drop me a message or a comment below. Guys, last thing we need to do is just talk about where these bond prices come from. This is the last chunk that we need to look at in this video. We've covered a lot of ground today. Three big things that determine bond prices. The first is risk. Greater risk or greater perceived risk means less demand for these bonds. If investors think that these bonds are certain bonds are particularly risky, there'll be less demand, causing prices to fall and yields to rise. And this is just an application again of the principle we saw earlier, that if things are more risky, there'll be more returns. And that's just the market functioning, because if they're more risky, there's less demand, pushing yields up. Incidentally, for governments, that means there is a risk of a debt spiral. Debt obligations, the amount I have to pay on my debt becomes more and more expensive, meaning I have to borrow more and more, which can reduce confidence further, which can push demand down, which can cause yields to rise further, which makes it more expensive to borrow. And the end result of that can be firms going bankrupt or countries defaulting, as nearly happened with Greece. So risk is really important. Secondly, the length to maturity. And that's because more liquid bonds are preferred. Ceteris paribus, if two bonds are equally risky, I prefer the one that's shorter term, because that means I get my money back quicker to reinvest in something else. That means the yields are therefore higher on long-term bonds, because the price will be lower because demand is lower. And incidentally, that forms the basis of something called the yield curve, which plots the different yields of different bonds with different lengths of maturity, and is a really crucial indicator of the health of the economy according to the markets. And if you're interested, you might want to go and do some research on what that means. Lastly, other market rates affect bond prices. So suppose bond yields are greater than market rates in other financial instruments. Well, that's going to mean more demand for bonds, pushing prices up, but therefore putting yields down towards the market rate. Whereas if bond yields are less than market rates, the opposite will be true. People will sell bonds for other things, so there's less demand for bonds, that pushes prices down, and therefore pushes yields up towards market rates. So bond yields will always tend towards market rates. Guys, that's everything we need to know with financial markets. We've covered a lot of ground today, so do make sure that you understand what we've looked at and go back through the video if there's anything you're not sure on. For now, though, that's us done. The next chunk we're going to be looking in more detail at banking.